Here's a thought experiment. Imagine you lent your neighbor $20 15 years ago. He paid you back, mostly on time, always with a decent excuse when he was late. You trusted him. But lately you've noticed things. He refinanced his house twice. He's got 3 new credit cards. He still pays you back, but you've quietly started keeping the receipts. You haven't said anything. You haven't confronted him. You've just started keeping the receipts. That is the most accurate description I can give you of what central banks around the world are doing right now with the United States dollar. They haven't dumped it. They haven't announced anything. They're just quietly keeping receipts. And those receipts are gold. Because gold has done something in the last 5 years that it hasn't done in decades. It stopped being boring. And when something stops being boring that was boring for 40 years, it's worth asking a very uncomfortable question. What changed? Let's talk about what gold actually is, because most people get this wrong. Gold is not an investment in the traditional sense. It doesn't pay dividends. It doesn't generate revenue. It doesn't innovate. A bar of gold in 1970 is the same bar of gold in 2025. What gold actually is a bet. Specifically, it's a bet that the systems human beings built to manage money, central banks, reserve currencies, government debt, are going to get messier before they get cleaner. Gold doesn't go up because the world is doing great. It goes up because the world is getting complicated. And right now, the world is getting very complicated. Over the last 4 decades, gold returned something modest and respectable, roughly 6 to 8% annually. That's the kind of return that gets politely nodded at in a financial planning meeting. But over the last 5 years, gold has been averaging close to 20% per year. That is not a modest return. That is gold putting on a suit and showing up to a job interview it wasn't invited to. So something clearly shifted. The question that nobody seems to agree on is what? To understand what's driving gold right now, you have to understand one of the most important but least discussed facts in global finance. The United States dollar has been the world's reserve currency for roughly 80 years. What that means practically is that when a country in Southeast Asia wants to buy oil from a country in the Middle East, they don't do it in their own currencies, they do it in dollars. When emerging market countries hold savings to protect their economies from currency crises, they hold dollars. The dollar is, essentially, the world's shared checking account. But here's what's changed. 20 years ago, central banks held about 70% of their foreign exchange reserves in US dollars. Today, that number has dropped to around 58%. 12 percentage points doesn't sound catastrophic until you remember we're talking about the savings accounts of entire nations, and that 12% drop represents trillions of dollars being quietly redirected. The dollar hasn't collapsed, but it's been demoted from unconditional trust to conditional trust. And that distinction matters enormously. The thing is, when central banks stop trusting a currency, they don't just sit on cash. They have to put that capital somewhere. And they're not rotating into euros, or yen, or yuan. None of those currencies have the kind of global confidence needed to replace the dollar. So instead, they're moving into something that has no government attached to it, no central bank controlling it, no debt ceiling debates or election cycles distorting it. They're moving into gold. And they're doing it at a pace that is genuinely historic. For 3 consecutive years now, central banks globally have purchased over 1,000 tons of gold per year. To put that in perspective, the previous decade average was somewhere between 400 and 500 tons. They have more than doubled their buying rate. And when asked about the future, over 95% of central banks said they expect gold holdings to continue rising in the next 12 months. Now here's where it gets genuinely interesting, because most people assume this is an inflation story. Prices went up, gold went up, cause and effect, simple and clean. But that explanation falls apart the moment you look at the timeline. Inflation was at its most extreme in 2021 and early 2022. CPI numbers were coming in hot. Supply chains were destroyed. Energy costs were surging. And gold? Gold barely moved. It actually declined for stretches of that period. So inflation alone isn't the answer. What gold is actually responding to is something deeper and slower. A structural loss of institutional confidence. Not panic, not a crisis. Something more like a long, slow exhale of trust. Because the U.S. has accumulated a national debt that is now well over $35 trillion. The interest payments alone on that debt are now among the largest line items in the federal budget, competing with defense spending, competing with Social Security. And foreign creditors, particularly central banks in Asia, the Middle East, and emerging markets, are doing the math. They're watching a country that is spending dramatically more than it earns, year after year, with no credible political path to changing that. And they're thinking, we don't want all of our eggs in this basket. Gold, to these institutions, isn't exciting. It isn't a moonshot. It's insurance. It's the financial equivalent of a smoke detector. You buy it hoping you never need it, but you feel a lot better having it on the wall. Act 4. The contradiction, 510 to 610. Here's the part that should genuinely confuse you, because it confuses professional investors. Right now, stocks are also near all-time highs. Risk assets are performing. AI companies are being valued at numbers that would have seemed like science fiction 10 years ago. And yet, simultaneously, gold is at all-time highs. This is not supposed to happen. In normal market conditions, these assets move in opposite directions. When confidence is high and the future looks bright, capital flows into stocks, real estate, and growth assets. Gold sits in the corner, gets ignored, returns basically nothing. But when fear creeps in, when uncertainty dominates, capital rotates out of growth and into safety, into bonds, into gold, into cash. The two don't usually party at the same time. What we're seeing right now is every major asset class sending a completely different signal simultaneously. Stocks are pricing in an optimistic future. Gold is pricing in a troubled one. Bonds are pricing in confusion. And what that means is that the market, as a collective, genuinely does not know what is coming. Not bearish, not bullish, uncertain. And uncertainty, sustained uncertainty at the institutional level, is the single best environment gold has ever known. Close, 610 to 7. So what should you actually take from all of this? Not that the dollar is collapsing, because it isn't. Not that you should sell your stocks and buy gold bars, because that's not the point either. The point is this. When the most sophisticated financial institutions on the planet, institutions that have teams of economists, decades of data, and trillions at stake, start quietly repositioning, it tells you something about the world they think is coming. They're not reacting to a crisis. They're preparing for one they can see forming on the horizon. They're hedging against a future they don't fully trust. Gold going up isn't the story. The story is why gold is going up. And the answer isn't shiny rocks or inflation or Reddit theories. The answer is that institutions are slowly, quietly, strategically reducing their dependence on a system they once trusted completely. And history tells us that when that kind of repositioning happens at scale, the world on the other side of it rarely looks exactly like the world that came before. That's worth paying attention to, not with panic, but with the same quiet, deliberate awareness that the central banks themselves are showing. Keep the receipts.